Learning objective 2 gets at the character of gains and losses. So when you sell an asset, you're going to have a gain or loss calculation that we've already discussed, but then you have to put a character on that. What I mean by that is all gains and losses are either going to be ordinary or capital. Ordinary gains and losses are just regular items that are subject to the regular tax rates, or the ordinary tax rates of a taxpayer. But capital gains and losses can be treated differently. Capital gains can get preferential tax rates. Capital losses can be disallowed. So we'll look at some of that stuff later on. But we have to be able to put a character on gains or losses. So in doing that, we'll look at the kinds of assets that you could have. Ordinary assets, capital assets, or Section 1231 assets. The chapter goes on to discuss these types of assets in further detail. Ordinary assets are things that are assets that are usually created in the course of a company's business. Like inventory is purchased, accounts receivable is generated by sales. These types of assets are usually only around for a year or less before they're either used up or sold. Capital assets are usually assets held for investment. They're not really business assets, and so the sale of those are going to generate capital gains and losses. The sale of ordinary assets will generate ordinary gains and losses. Section 1231 assets are business use assets, so used in a trade or business and held for more than a year. So these are the assets that really we're going to be focusing on when we're talking about character issues, because when you sell Section 1231 assets, you can arrive at either capital or ordinary gains or losses depending on the nature or depending on the circumstances. This is a good little summary, Exhibit 10.3 right here. The character of the gains and losses if you sell different types of assets.